Alright, so in my last video, we talked about some things we needed to see by Friday, by the end of the week, in order to say, okay, we're still in the noisy period and we're going to noise our way back up. Well, now we haven't broken necessarily through support yet on the S&P, but there's some signs that we didn't see and a few other signs that now we do see that suggest that we might, be starting a pullback here, an actual pullback, and more than just noise over the next week or two, or going into the next few weeks. So I'm going to break down all those signals and why they're suggesting that now, and why they didn't before, and what makes them different from the noise that we've seen. And then, what's the likely scenario for a pullback? How bad will it get? Will it be bad at all? So I'm going to break that down as well, and what to expect in terms of the timing of it, and then how to trade it. We'll take a look at a trade idea today that has a relatively high probability for a directional trade to take advantage of this weakness. So let's go ahead and get started. Today is Friday, June the 26th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 here with the market forecast indicator, and you see that we have a little bit of a bearish sign on the S&P, a little bit of a bearish end, but producing, obviously we had a sell-off at the end of the week, but up until this week, up until today, it finally produced a bearish sign, and that is, first of all, an extremely oversold momentum line again. So we've gotten progressively, multiple oversold momentum lines. A bearish near-term high that's getting in lower, and now it didn't get oversold, but the key here is that you have a intermediate line that's falling below the market sentiment line, and kind of coming down from this peak that also didn't get above 80. So, a little bit of a bearish sign here. Now we haven't broken the 23% level yet. We have produced this bullish pattern, actually, this light pink shading and yellow line. It's actually a relatively bullish pattern on the chart itself. We're not breaking even below the 62% level. So, there's some support in this area, with the next layer of support kind of in this area here between 2800 and 2836 or so, 35 or so. So you can see I got multiple Fibonacci retracement lines. The black ones are based off of the decline and subsequent rally, and then the blue ones here are based off the rally and the subsequent pullback now, measuring the current pullback here. So relatively bearish. Now you notice on the NASDAQ, we're not even close to touching the 23% level. So you could almost say that by the time we ever touch the 38, which would be a pullback, which would be probably the highest probability scenario right now that we'd expect, that we'll break the 23 and hit the 38. By the time we hit that 38 on the S&P, we'll probably be hitting the 23% level on the NASDAQ, and that would not be a pullback. It would be a pretty deep drop, but, again, remember, anything between 0 and 23% is a noise. It's not a pullback until you break the 23% and you get down to the 38, at least to the 38. So that's the big difference. We might get a light pink shading on here on the NASDAQ because I don't expect that we'll get below the 23% unless things really kind of go sideways for the S&P. Now keep in mind, the Russell 2000 has broken back down below the 20, even though it's also producing this bullish pattern of light pink shading and the yellow line. It has broken back below its 23% level. It's not crossed below its market sentiment line, however, so not, as oversold as the momentum line is, and the near-term line also producing these bearish highs, we haven't really broken down here either. So there's signs of bearishness, or signs that things can kind of turn sideways a little bit here, and I would be leaning more in that camp, actually, that will probably pull back in the highest probability scenario to the 38. I don't expect to pull back any more than that, maybe just a smidgen more into this 50% retracement, but that's where your pretty significant support level is going to be when you look at like the Bollinger Bands here. You notice that here's your 23% at around the 300 mark, and then after that the bottom of this volume node is at the 38%. So if you break that, there's not a lot of support holding us up from coming all the way down to the 62% level. So I think that that's the least likely scenario. I think we'll come down to the 38, hold it for support, and bounce off of that where that support is. You look at things like the RSI and the CCI, and while we're breaking below 50, we haven't broken below 40 yet. And you notice on the NDX, we're not even breaking below 50 yet, much less just barely breaking below the midpoint. So again, I expect, that during this pullback, I expect the NASDAQ to outperform, as it has been doing during the pullbacks, which is actually a good thing. Things really hit the fan if the NASDAQ starts to underperform during the pullbacks. All these big tech names start to really sell off more than everything else. I don't expect that to happen, but that's when we'll be really bearish. That's when it's like, okay, we're not like, the worst case scenario is going to play out. And my best case scenario is we hit that 38% level. We get a little bearish here, maybe flirt with breaking below 40, but not by much. Something like this maybe, or something even like this maybe, where we kind of break below 40, but we don't stay down there and have this bearish move. That's kind of what I expect. And maybe, even here we got below negative 200 on both of these, and below 40, but we didn't start a bearish trend because we popped right back up. And I would expect something similar to happen here. Hit the 38, then pop up, and we might even kind of go up and down around there between the 38 and 23% layers for, a couple weeks on this chart. And you see, when you look at the Ichimoku cloud again, we're not anywhere close. And again, we can come down to the 38% level and still be above the cloud. And then bounce off of that and maybe flirt with trading in the cloud for a while. But you can see from the trend strength and these indicators down here at the bottom, we have lost our bullish trend. So another sign that, unlike this little drop, that this one might turn into more than just a little drop. It might be the pullback that we've been kind of expecting, since we've been on this bullish run for so long. The Chiku line here on the Ichimoku, is the red line still above the price, so that's still bullish. But you can see within a few days that won't be if we stay down here, that won't be the case. That will be, when we were bearish during some of these pullbacks like this one here, you notice we did get below the price. So I do expect, now it's going to be, whereas over here, right there, we were well above the price. It would have been really hard for us to get below it. Now, not so hard. We stay around here for a few more days and we're below it. So that would be also a sign, a signal of a pullback. Again, not falling off a cliff, not dropping through the floor, not breaking support, but just breaking the 23% line and finally producing a pullback, right? Where we might come down here and then we might come up and down between 3,000 and 2,800 or a little bit above 2,800 for a few weeks before we finally break back above the 23% line and stay above it and then continue to trend higher. So something, we came down here, we came up and down. We even went above the 23% line for a while over here and then came back down below it, but still held the 38% level easy. Finally broke back above the 23% line right there. If we were looking at this earlier in my Q&A session, finally broke above it there and stayed above it, and that's where the trend took off. So, eventually that would happen. But like I said, it might be a few weeks as your typical intermediate pullbacks that aren't so bad. And that's about how long they last. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, that you want us to do another one on Monday. It's a quick way to give us feedback and tell us that you like our videos. If you don't like them, you don't have to click on anything. If you want to let us know that you do like them, you can do it with one click. You can do it right now while you're watching and let us know. Also, while you're down there, comment. What questions or comments do you have about anything I talk about in the video today? Post those down below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It takes you to a page on our site that you can where you can subscribe for free. Follow me on Twitter for more content in between videos at davidsettle42. And also join our Market Outlook Facebook group that we've created. If you're watching us here on our website, click on some of these other things here. If you click here, you can watch our Market Outlook live videos, as well as these are classes. So these are 3 of our upcoming trading rooms. Our monthly subscribers get access to all 8 of our trading rooms that we do every week. as well as our Market Outlook Live. So every time I do the Market Outlook at 3:30 Eastern, I also do a Market Outlook Live video. So it's where you can come on and listen to me review all the old trade ideas I do, as well as put on today's trade idea before the market closes. We already put on today's trade idea, and we continue to manage them. We also invite you to engage with us here on social media. Click this heart. It opens up a new window, and click on that like button there. Click on this thumbs up icon. It takes you to your Facebook page, and you can click on that like button as well. Appreciate the comment there. The more you do those things, it benefits us, because the more likes these posts have, the more Twitter and Facebook will promote our content to all of our followers. It benefits you because Twitter and Facebook promotes content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, back to the charts. I did want to take a quick look here as we go to the weekly chart. I want to take a look at the weekly chart on the market forecast. And you notice again, we've had dark green shading for quite a while on the S&P, but you notice what we haven't had is a green line. Like, that's the combination that's bullish when you get the green line. And you can see over here we didn't have the green line for weeks either by the time we turn dark green on the shading coming off of that December. But if I go out further to kind of give you some perspective, when you get the dark green shading and the green line, you're pretty bullish for a while. There might be some light pink shading along the way, but that's when you get pretty bullish. And it's sometimes, when you're starting, it can take a few weeks before you get the green line after you've had the dark green shading. Well, here we've had the dark green shading for a while, and we've only had the green line the 1 week, and it immediately reversed there. You look at the Russell 2000, and we haven't even come close to having a green line. It's back to being red. But then you compare it to the NASDAQ, and we've easily had the green line and the dark green shading. So you can kind of get an idea of just how bullish some of these are. Now, we're also coming up on the end of the month. We have a couple days left in the monthly period. So if I were to take a look at a monthly chart and say, okay, well, how does things look here? And you can see, we've had light pink shading, but you see how bullish how bullish of a month this has been. And if you look at the SPX, one thing that really stands out here is that long upper shadow. Look at that. That's not too common for us to get long upper shadows on monthly charts, and they tend to be pretty bearish, actually. So we'll kind of see how we close the last couple of days and whether we get below the 23% level or not. But that's another sign that, we might flirt down here to the 38% level before we really get going. And you notice here we still got we've got the green line again on the monthly chart, but we don't have the dark green shading yet. And we might not have the dark green shading. We might actually get a yellow line again by the time this is all said and done. And kind of give you an idea, we've been dark green on a monthly chart, mind you. We've been dark green shading in a green line since 2009, right? So there's your 2009 low that got us up to it, and then this is 2010. So this is when QE started, and you can see we finally, and there's 2011 where we came down to it and we continued higher. There's the in between the two bear markets, the bullishness that we had there. It takes a while. It takes some months to get to the dark green shading and green line. But you can also see when we get pink shading here, it can take a few months for that to clear itself back out. And that's currently where we're at right now, at least on the S&P. Like I said, on the NASDAQ, not quite the same, because we've had light pink shading and we're just right back up to new highs here. And we still haven't, we're not anywhere close to getting anything different. A little bit of a potential of a near-term divergence, but nothing really more than that. And on the SPX, you can kind of see the same thing. The near-term line's kind of got the potential, but you see the market sentiment still strongly bullish. The intermediate line's actually down further than it's been since this recession. So, it's kind of like over here in 2008. See, this is 2007 when the stock market peaked. October or January 2008 was pretty bearish. But then we kind of, hammer around. We're trying to bounce back up here by May of 08. By May of 08, to kind of give you an idea what that looks like here on this chart, on this crossover chart. There's May of 2008 right there. And then we continued, and we turned into a bear market at that point. But we had a death cross environment there. We don't have that death cross environment anymore. In fact, we just barely got a golden cross, and we've gotten a couple of transitions. So we'll see if this, you would expect that these transitions would lead to some bearishness. So we might get some candles here where we flirt down to the 38%, and that would be a pretty decent distance below the 200. But like I said before, I think there's a better chance that we'll hold the 38% than we don't, right? And if we break down, there's nothing to hold it down and hold us up. So if we break the 38, it's going to be very easy to break all the way to the 62. And, that would be significantly bearish and lowest probability in my opinion. So I expect more likely than not that we'll hit the 38 eventually within a few weeks and then come back up. And at the same time, the NASDAQ would be coming down to its 23%, right? So it's still not even getting a transition candle. And I wouldn't expect, if it does, it would be something like this, and we'd be flirting with the 50-day moving average, not coming below the 200 like we're doing on the SPX. And then the Russell 2000, you can see, still hasn't got the golden cross, and it's flirting in between. So coming back down to its 38 would actually be getting back below its falling 50-day moving average, which is currently below the 200. So it kind of shows you that, that if we're going to follow the NASDAQ's lead, these others still have a long way to go to catch, to get close to where the NASDAQ's at. So as long as the NASDAQ outperforms during the pullbacks, then I still would expect these to catch up to where the NASDAQ is. But if the NASDAQ starts to underperform during the pullbacks, then I would expect the NASDAQ to catch down to where like the Russell is. And that obviously would be a lot more bearish. I don't expect that to happen. Looking at the two-line versions of this, you can also see too that we talked on Wednesday that by the end of the week we had closed below 17. By the end of the week we need to get back above the 17, and we didn't. So now we've been trading for a few days here below a falling 8-day moving average. And now we've closed below the 30 after flirting with it a couple days ago. We've closed below it. The 8's closed below the 17. The stochastics is coming down below 40. So, while there's, like I said, these other oscillators that aren't necessarily there yet, but you can kind of see the signs here that suggest that there's a pretty good chance we'll probably break to that 38% level on the S&P, even based on this chart. So just another indication, another signs that, next week, a week after, going into July expiration, which is seasonally actually pretty bullish, might not be so bullish this go around because of, there's, that things are different with this coronavirus. It's kind of thrown off seasonalities. So we might be in that mode right now for a few weeks where we're a little weak going into the end of the summer and then eventually into the election cycle. So we'll kind of see how things play out, but it's leaning like, again, I don't think we're going to be falling off a cliff or falling through the floor, but I think there's a good chance that we might start, a move lower. Like this little noise, up and down noise, is going to lead to, an intermediate decline, where the intermediate line falls eventually below 50. But I don't expect it will be, anything more significant. We talked in our technical analysis class on Friday about the concept of intermediate pullbacks, the depth of them as well as the duration of them. That both those things factor into intermediate pullbacks. 30, getting below the 23%, that would be the depth. But the duration means it could be weeks. But just because it might be weeks that like say 4 to 6 weeks that we're in this intermediate decline, that doesn't mean that we'll be falling for the whole 4 to 6 week period. More than likely, we might hit that 38% really quickly and then just kind of hover up and down between the 23% and 38. And that's what, these are suggesting, that there's a good chance that instead of hovering between the 0 and 23, we'll start to hover between the 23 and 38 instead. Let's take a look at the intraday chart here. You see how we're trading. There's a 23% line right there, so you can kind of see it on the intraday basis. And we closed below the value area after kind of flirting a couple days ago with being above the value area. We came right down to the bottom of it and are flirting with, when we've done this before, a few weeks ago. So you can see how important it would be. And if I were to go out a little bit further here, and let's change this to a 30-minute. Then you can see there's that 23% level. There's also, a pretty significant volume node. So you break through here, and then there's the next volume node at the 38% line. So that's why I say there's some pretty strong support that we can build out in this 280 to 283, 284 area. That can build out that volume node and build some support there. And then you can see where the 62% is at the bottom of this 90-day value area, as well as that last little volume node here. So there's some pretty strong support. We're not going to be falling off a cliff here. We might pull back to this level and then just kind of go between 280 and 300 here for a while. Let's look at today's volume here. So volume was over 100 million, 127 million. The trading range today was over average, so both numbers above the average, but the averages are pretty darn low. So it's not like, you can see how the averages are lower, from where they've been, but not as low as they've been, when we're bullish. So again, it kind of shows us that we're not really established yet in this bullish move. This is all of this bounce and how big it's been is just a function of how big the sell-off was here in March. This drop. Nothing more than that. So we're not really established yet in this bullish move. You can kind of see on QQQ, we're still even relatively high on the QQQ, above 2%, whereas back over here, we were kind of in the under 1% range, and we peaked at 2% during these intermediate pullbacks. So we're not quite there yet. We need to really kind of break down and settle down on this volatility, settle down on the historical volatility. You can see both historical and implied are slowly rising. So, this has got to settle back down, right? The implied volatility will drop first and faster because it's still pretty high. If you look over to the left, this is still a pretty high level of implied volatility. You see this. So, when it falls, it will fall faster than historical, even at this level. So, at some point in time, for us to be really established in our bullishness, that purple line is going to fall below the blue line. And that would mean that volatility here would be breaking below. Instead of being up here above the 95% mark, we have to break below the 90 and stay down here. And we're just not there yet. But the nice thing is we're also not breaking above the 100% mark either. So, this, as bearish as we were, last time we were this bearish on the VIX, when we got up to this a couple days ago, the VIX was over 100% easily when we were at these levels, and we made a jump higher. We didn't this week. By the end of the week, as bearish as we were on Wednesday and then again on Friday, we didn't get above 100%. So that's why it's we're not going to fall through the floor. We might break below the 23% level on the S&P, but we might not on the NASDAQ. And that would be a good thing for our bullishness there. So to summarize those charts, we've still strongly bullish, and we've been strongly bullish because of how big the selling has been, and we are getting some weakness, but the weakness isn't as dire as it seems based on the how people are talking about in the media or on Twitter or anything. It's from right now, from a technical perspective, it's just noise, and it can turn into a little bit more than that, but most likely won't turn in more than just a shallow intermediate pullback, which is typical of bullish long-term trends. You just kind of get these 38% retracements and really nothing more than that. And that's kind of what I expect here. And there's a lot of charts that are showing that we're leaning towards the pullback, but also a lot of charts that are showing you wouldn't expect it to be anything more than 38%. Maybe a small dip below to that 280 level. And then after we hit it, which could be by next week, we could do it, again, we can hit that level pretty quickly. It's just a matter of staying there now and kind of up and down there. That can last 4 weeks. So now, that means we could be hovering between 280 and 300 on SPY, for example, for multiple weeks here. And this might be the week that we actually hit. But at the same time, if we hit 280 on the S&P, we're probably still only hitting the 23% level on the NASDAQ. And if that's the case, great. As long as the NASDAQ keeps outperforming during the pullback, great. Because that means we're still bullish, right? And it's when the NASDAQ underperforms and catches down, that's when we know we're going to probably start a bear market, a real bear market, where we stay down, not, we don't go down 30% in 4 weeks, we go down 30% in 4 months or longer, and it's just more gradual and worse, more pernicious than just a quick drop and bounce back like that. So what do you think? Do you agree with that outlook? Do you disagree? Let me know in the comment section below, especially if you disagree. What are you seeing that would suggest either you're a lot more bullish or a lot more bearish than what we came up here with our chart routine? All right, now let's talk about some of these other markets. Let's take a look at this chart here, and let's take a look at this last week that was. So let's come all the way over to June. We'll go to the 22nd in the 10-minute chart. So this would include, the moves at the beginning of the week, coming off of Sunday night. By the end of the week, gold and long-term bonds were up, and small cap stocks, large cap stocks, U.S. stocks really underperformed internationals. Internationals had a great week. That's not been the case, for a while. Like, you go for the 1-year chart, and you can see on a 1-year basis, gold and bonds and the Qs have been done really well. On the other end, you have international stocks and small caps have really underperformed. But this week was a good week. It continues to be a strong week for safe haven. Here's another reason why we're not going to start a real bear market anytime soon, because real bear markets don't start with 1-year returns on these safe haven assets of 25%, right? That's the kind of returns you get during a bear market, which, like I said, I think we have been in since that January 26th peak in 2018. I believe that we've been in a bear market in most asset classes. You can see long-term bonds and gold are up 30+% since that time frame, and the Qs are up 42%. The stock market, the S&P itself, is up only 6%, and the dollar's up 13%, and everything else is down, 20%, 14% on the Russell after coming off of these lows. So, you can see that is typical of a bear market. And the only reason why the S&P looks so much better than all these others that are way down here is because of the Qs, right? Those large cap tech names, have done really, really well and have been able to hold up their value even with everything else just, falling out of bed, so to speak. So some of the bigger movers here this week, as we mentioned, gold and long-term bonds. If you take a look at the weekly chart for TLT, you can see it's been a good couple of weeks to the point where TLT looks like it's trying to bounce back above its 23% level and potentially make another run up above its rising 50-day moving average, right? So, it's already got, like, its PPO, if you go out as far as you possibly can, its PPO up here, it's been to 10% before, and that's about it. So, I don't expect the PPO to get higher. Now, we might form a divergence, this one like this, where we got a higher high, but this one took weeks. I wouldn't expect the next divergence to take weeks. It might occur over the next 4 to 6 weeks, where long-term bonds might make a slightly higher peak, say up to 171.5, maybe 172 to 173-ish, maybe 175. So slightly higher, not as high as that peak, but slightly higher. And then come down from a lower high point. And you look at gold and you see, it's continuing to march its way higher. So again, not usually the case. Like, when you go back to even 2017, gold, we weren't coming off of a high on gold. You look at 2009, that's the only period where really we were already pretty high on gold. And then it continued to even go higher, even as stocks are going higher. And that's the kind of thing I expect to see here, actually. I expect gold and the dollar, gold and stocks to really kind of make a run here, because I think the dollar, and you can see the dollar is just now forming a death cross on this. And from a market forecast perspective, it's forming a long-term bearish pattern here. And we've had a little bit of an oversold bounce on the daily chart, but the weekly chart suggests that we might be in for a bearish move on the dollar, where we get dark pink shading and a red line for a while, right? For a while here, and that would be very bullish for risk appetite and bullish for gold too. but bearish for yields, or for bonds. You would expect yields would eventually finally make a run up. Here's the weekly chart, and you can see how bearish we are. In fact, here, let's look at the PPO, and it's still, that, like, we dropped 30% on the yields. That's in fact, if I have to go here, let me go. I did it in my class today too. Let me find this has more data on it. It goes back further. So if I pull this up instead of TNX, you can see again PPO got down to 30%. But if I go all time on this, as far back as we can possibly go, you can see we've never even come with the worst we've ever gotten was like 12% on PPOs. So to get down to 30, which, here, these two were really bad in and of themselves, and we've essentially doubled those here. So, I don't expect that we'll go down, maybe go down slightly lower low, like again on TLT, before we form that bearish divergence. We could very well form a bullish divergence here where we get, a lower low but a higher low on the oscillator, and, expect that to turn around. That's kind of what I'm expecting during this current intermediate pullback. Getting down to slightly lower lows here, but eventually bear markets don't start with the PPO on yields. I mean, here's the last bear market that we had. It started at the end of 2007. PPO wasn't at extreme lows by then. Right here is where the market peaked. We weren't at extreme lows. It made extreme lows after it started. Here's the 2000. PPO was not extreme lows. It was at extreme lows for its time at the end of the bear market. You can see here in 1987 here, the big drop that we had in 87, that occurred with yields on a bullish move, so no bear market there. Here's the 90s where we had some bearish moves in yields and some weakness in stocks, but nothing significant, and the worst of it was at the end of the run. See, the worst of the PPO was at the end of these runs. So if this is the end of the run, then bear markets don't start then. They end then. So we might be at the end of one. We might get a year or two where this recovers, and then the PPO gets to highs. Then we get our bear market, if and when that ever starts, our real bear market that we haven't had since the 07 to 09 move. If you look at the sector comparison again, you'll see how you'll see why I don't think again that we're going to be falling through the floor anytime soon. You look at just this week that was and who performed the best, and you can see technology is still there, consumer discretionary is still there. The communication services had a bad Friday, and they were one of the Facebook and Google had really down moves on this ad spending thing, so they really came down. But until then, they were up there too. And then you can see financials got hit with the dividend payments, and energy got hit, industrials got hit. So when we're weak, these small cap sectors lag, and when we're weak, these QQQ sectors are still leading, and even during the weakness. So again, great. That's what you want to see, right? That's what you want to see to make sure that we maintain the bullishness. If you look at the 12 grid here for these, you can see how we're getting some dark pink shading, right? Now, only a couple of them have the red line 2. Healthcare and utilities have the red line 2. Financials and staples and energy have yellow lines. But you can see, lots of light pink shading, yellow lines here on these charts. And look at technology, still has a dark green shading and a green line. So, it again just goes to show where the weakness is and where the strength is. And as long as we're, that maintains itself during the weakness, then great. If it shifts during the weakness, then uh-oh. But I don't expect that to happen, and it hasn't been happening or showing any signs of happening yet. The only, the days where these small cap sectors outperform energy, financials, industrials, those are the days that everything rallies, not drops. And so that's good. That's what we'd want to see. So for our trade idea today, I wanted to actually take a look at a bearish trade. We haven't done that in a while, and In this case, I wanted to look at Nucor. If you take a look at Nucor, you can see it's broken below its 23% retracement. It's flirting with its support. It's got light pink shading the yellow line, but you notice its intermediate line has easily crossed below its market sentiment level. So that's not the greatest thing. And you look at its 3 green arrow chart, and you see its 8 and 17 day are both falling below the 30 now. We've been below the 8 day for multiple days, like 8 days in a row, 6 days in a row. And the moving average, the average of the MACD is about to fall below 0. The stochastics is easily falling below 40, where over here it did briefly but then popped right back up. Not so much right now. Its moving average is falling also almost below 40. You look at some of these RSI and CCIs, and you can see they're not looking the most bullish, right? They're starting to, last time we hit 40, we hit it hard and bounced off of it. We've been doing a lot more gradual. That's a lot more bearish as we do this. And so you can see, we're not again, even on Nucor, not falling off a cliff here. We're below the blue line and staying below the blue line. We're getting, kind of flirting with this -1 and 50 on the trend strength. The red line's flirting with crossing below the price. So things are kind of looking like they're leaning that way. So for our trade, what I did was here we go. What we did for the trade was we looked at selling selling the 35 put and buying the 37.5 put. So it's a relatively high probability trade. We spent a lot of time on this in our technical analysis class. Looking at different varying degrees of bearishness. This one being kind of like a representation of the higher probability directional trade, where the max gain's easily inside of 1 standard deviation. And if you look at its its Bollinger Bands here, you can see how we're flirting with this volume node, breaking below that, and the next layer of support's at 35. And so that's where okay, well, if we sell down there and there's some pretty decent support here, then we can get a good gain if we trade around in that area. For a relatively easy risk, right? Our worst case scenario is $500, but really easily we're going to be able to get this to half of that if we do bounce up and this trade doesn't work. You can start to see it's down a little bit since we got into it. So we sold the 35, bought the 37.5. The 35 for July was was actually at a better delta, but it's a relatively lower delta. So it gives us the ability to get a decent reward, $1,200 for about $250 of risk ultimately by the time we get out if we do bounce. So pretty decent risk reward for a relatively high probability, considering how easy the max gain is inside of this 1 standard deviation channel. That kind of says, okay, there's a pretty decent chance this directional trade can play itself out. Alright, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have and reply to anybody else's threads. And let's keep this conversation going in between videos here. Again, thank you very much for watching. Subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video down below. Join our website at marketscholars.com and our Facebook group that we've created. And also follow me on Twitter for more content in between the videos at DavidSettle42. Have a great rest of your weekend, everybody, and we'll see you all next week.